Okay, absolutely quiet for the markets. Let's take it across to Mayuresh Joshi, find out what he's making of the market texture. Mayuresh, hi, good to chat with you again. What is it that you're making of the commentary which is currently coming in from the RBI board meet? The first one to be chaired by the newly appointed RBI governor. And it seems like, while he did apprise himself on the situation of banks under PCA, on the liquidity situation, nothing material has really come about as to what he intends to do and ease more liquidity in the system. Do you think this would disappoint the markets?
So two things, Aisha. First of all, good afternoon. I think the governor's appointment has happened just a couple of days back, and the way the market has reacted, I think he has been well accepted by both the bond and the equity markets. The second element, obviously, in terms of him calling for a press conference and proactively communicating to the investors and the media persons alike, I think that shows a very, very positive sign. The third element, obviously, is the kind of expectations that the market probably has in 2 days of a new governor probably coming in. So you need to give some amount of time to the new person at the helm of affairs to probably reconcile with the kind of workings that the RBI has gone out with over the past so many months, and to come out with a clear and a concise roadmap. So to that bit, I think there were a lot of expectations that the street has. The street always has these expectations. So is the street disappointed in terms of nothing coming out? I think it's not fair enough for the new governor to make decisions in a couple of days' time. So I think in all fairness to the governor as well, I think you probably need to give some time, and the street might get disappointed, but I think it will reconcile to the fact that whatever decisions will come through, I think happens through a very constructive decision-making process at the RBI level. So yes, I think maybe the street is a little bit disappointed, but I think the reconciliation might come through over the next few days.
Okay, Mayuresh, let's get stock specific here, or sector specific, I would say, and within those sectors, if you have some great ideas to offer to our viewers. Cement space. Now, we are talking about, I'm just trying to link two different parameters over here. People are anticipating easy lending norms going forward, looking at the changes which have taken place in RBI, because of which NBFCs and other banking stocks are doing well. Do you think this would lead to higher infra spending, new projects coming up, and which would eventually lead to cement space doing well? Because we are seeing since last 3 trading session, cement stocks are making a good comeback, and if I have to add a bit of short-term aspects into it, we are seeing long formation and not just short covering.
Afternoon, Siddharth. I think 3-4 quick pointers here. I was at the Economic Conclave yesterday and I was hearing the Exchequer out, and he clearly elucidated the point that infrastructure spending is a must for the government over the next few years as well. Having said that, again, I think if you dissect the industry as a whole, the kind of capacities which are expected to come up are very marginal in nature over the next few quarters and years. The second element in terms of the skew that the industry probably works out at this point of time, and if you probably dissect the entire country into 4 zones, I think the western part and the northern part of the country has been doing well. The central part selectively, I think with no capacity additions happening and utilization levels for the industry as a whole being there around 75-80% augurs well. And the third element in terms of the companies based out of the south, so we also had issues related to sand mining. Obviously the kind of competition intensity that you probably had with a lot of players ramping up their volumes, incrementally pushing down the prices or having the prices not rising too much, in a scenario where I think the input costs over the last few quarters had risen quite sharply, both in terms of the power and fuel costs moving higher and the freight costs moving higher because of elevated crude prices and the depreciating rupee, obviously dented the EBITDA margins. Now over the last few weeks and months, you've obviously seen petcoke prices come down. A lot of these companies have initiated cost optimization programs. To add to that, again, I think the waste heat recovery plants or the captive power plants that a lot of these players have put up are going to ensure that the cost savings probably happens on the power and fuel costs. And considering freight, again, I think with higher tonnage vehicles coming in over the next few months and crude going down, obviously I think gives a huge bottom line boost both in terms of the EBIT and EBITDA per ton that they report. Having said that, I think selectively companies based on the south, India Cements for example, where our own sense is that the volume growth should be quite reasonable over the next few quarters, with the assumption that the waste heat recovery plant coming through, the CPP plant of 50 megawatt of Visakhapatnam, the usage of PCC as an input, and again I think Indonesian captive coal reduces their cost dynamics quite significantly. So I think there is a clear leverage that can get played out. And again I think of the central part, I've discussed this idea many times, I think Heidelberg Cement, though the valuations are on the higher side, the expectations of EBITDA per ton moving significantly higher, their utilization levels actually touching 85, 90 or even beyond that over the next few quarters, pushing the volume-led realization story and the leverage on their balance sheet and the cash flows ensuring that debt reduces for Heidelberg as well as for India Cement. I think these stocks are probably in a very, very sweet spot. A clear disclaimer, we might be holding these stocks in our funds.
Naresh, what's the call on Yes Bank today? After many sessions, you're seeing a bit of a bounce?
So again, Tanveer, I think the three main moot points that surround the bank. A, I think further clarity required in terms of who actually comes at the helm of affairs and who manages the show thereafter. The second element obviously is the divergence with the RBI in terms of asset quality. And to a certain bit, again, I think the kind of provisioning that the bank has embarked upon, I think the PCR is going to improve going forward with elevated provisionings continuing, which is going to be a healthy sign in terms of balance sheet dynamics. The third element obviously is the Tier 1 ratio at this point of time. So as the new person comes in on board, I think the capital raising exercise is mandated to be done at the earliest if they want to sustain the run rate of 30-35 odd percent in terms of their advances growth. So again, I think the building up in terms of the granular liability franchise, the CASA build-up has been quite reasonable in my perspective. But these 3 points will still keep on playing out as headwinds for the stock. As clarity emerges, and as Nayantara was mentioning, I think if there is further clarity over the next few weeks, I think you will have far more sanctity in terms of what to do with the stock, in terms of where the stock price might head. In terms of value, is there value? Obviously, I think at 140, 150, I think there was deep value in the stock. But assumptions are that the book value still looks pretty attractive at this point of time. So I think it's how these three variables play out. I think as they play out, and if they play out effectively as the street expects, I think there will be some amount of upgrades that will come through in terms of the book value that Yes Bank can deliver and the earnings that it can deliver over the next few quarters.